Ladies and gentlemen, good day and welcome to Neogen Chemicals Q3 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nishit Solanki. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and welcome to Neogen Chemicals Q3 FY24 earnings conference call for analysts and investors. Today, we are joined by senior members of the management team, including Dr. Harin Kanani, Managing Director, Mr. Anurag Surana, Director, and Mr. Ketan Vyas, Chief Financial Officer. We will commence the call with opening thoughts from the management team, post which we shall open the forum for Q&A, where the management will be addressing queries of the participants. Before we come in, I would like to share a standard disclaimer. Certain statements made or discussed on today's conference call could be forward-looking in nature. The actual results may vary from these forward-looking statements. A detailed disclaimer in this regard is available in Neogen Chemicals Q3 FY24 investor presentation, which has been uploaded on the stock exchange site. I would now invite Dr. Harin Kanani to share his perspectives. Thank you, and over to you, sir.
Thank you, Nishit. Good afternoon, everyone, and thank you for joining us on Neogen Chemicals Q3 FY24 earnings conference call. We released our quarterly results on Friday and subsequently distributed the earnings presentation. I trust you had a chance to go through them. I will be guiding you through the performance highlights, important developments, and update on expansion initiatives, after which Mr. Ketan Vyas, our CFO, will walk you through the financial performance. Our performance during the period under review was marked by sustained weak demand environment, influenced by recessionary trends in few geographies. This, along with persistent inventory destocking, ongoing conflicts in Middle East and Red Sea crisis collectively hindered the momentum, leading to a sharp correction in the prices of the raw materials. Both our key end-user industries, agro and pharma, continue to be under pressure, bearing select products that remain stable. In light of this situation, I believe we have performed satisfactorily while preserving our base volumes and then managing at least a small volume increase. This achievement was aided by the resilience of our business model coupled with active engagement with customers and partners. We are beginning to observe a gradual demand recovery in pharma sector and select pockets in agro and anticipate this trend to gain momentum in the future. On a consolidated basis, our performance appears weak, primarily due to two factors: initial expenses, capex linked to battery materials arm Neogen Ionics, where contribution is yet to come, and one-time impact on Bulichem and a little bit on Neogen due to liquidation of high-cost inventories in lithium, in addition to subdued demand for products linked to agrochemical and pharma. Our standalone performance, on the other hand, exhibited slight improvement as we navigated through the sector uncertainties. For Q3 FY24, our revenue stood at 167 crore, while EBITDA came in at rupees 26 crore, PAT at rupees 6 crore. Mr. Ketan Vyas will provide a detailed overview of our financial performance. Moving to our segmental performance in Q3 FY24, organic chemicals revenue reported a decline of 5%, mainly on account of year-on-year drop in bromine and other RM prices, which, when adjusted, increased our revenue by rupees 12 crores. Likewise, inorganic chemicals revenue declined by 30% year-on-year due to steep fall in the prices of lithium raw material, which otherwise would have been higher by 23 crore if we compare to the same period last year. Let me now share an important development. Neogen Ionics Limited, 100% subsidiary of Neogen Chemicals, recently completed land acquisition totaling approximately 264,285 meter square in Pakhajan, Dahej, PCPIR, Gujarat, to establish a world-class state-of-the-art battery materials facility. This greenfield site will be our largest facility dedicated solely for battery materials and new future business opportunities. Here we will set up electrolyte plant using manufacturing technology license from MUIS Japan and electrolyte salts and additives plant based on Neogen's indigenous technology. The MUIS team has completed the design of the plant, and accordingly now we are preparing ourselves to start construction of the plant. We expect permissions to be received by March, and by March or April we expect to start construction of the 30 KTA electrolyte plant. This plant is expected to be operational in second half of FY26. Coming to our existing expansion initiatives, our battery material project is progressing well and adhering to the schedule and advancing with the plant design using MUIS Japan technology. Construction is also expected to begin shortly thereafter. Let me provide you some more specific updates. In our existing business, brownfield expansion of specialty organic chemicals by 60 meter cube, out of which 31 meter cube was already commissioned till Q4 FY23, and remaining 29 meter cube will be commissioned by during FY25 depending on business needs. In the battery material business, new capacity of 400 metric tons per annum for lithium electrolyte salt and additives. Trial productions have already commenced stage-wise, and final check and tests are currently ongoing. We expect customers' approvals to start coming through by end of Q4 FY24 and start revenue by end of Q4 FY24, early Q1 FY25. The 2,000 metric ton electrolyte manufacturing facility at Dahej using our indigenous technology is also scheduled for commissioning by end of Q4 FY24. Furthermore, we propose to expand our lithium electrolyte salts and additive capacity at Dahej SEZ to 2,500 metric ton in phases, which will be operational during FY25 to cater to immediate demand of electrolyte salts and additives in the international market. At our new greenfield site at Pakhaj and Dahej PCPIR, we will set up the 30 KTA plant using MUIS technology and 3,000 metric ton of electrolyte salts and additive plant using our indigenous technology. The aggregate capex for all these capacities set to come online in FY24 and beyond will be close to 1,500 crores and will translate into peak revenue potential ranging from 2,500 crores to 2,950 crores depending on the lithium prices. This investment will be done in a phased manner and funded through mix of debt, internal accruals and recently raised equity. Once operational, these projects will drive us into a rapid growth trajectory in the sunrise sector of lithium and battery materials, leveraging our first mover advantage over competitors. Our aim is to become the most dependable player by maintaining consistent product quality and ensuring timely supply. This will establish Neogen Ionics as the market leader for electrolyte in India for EV applications. While this remains, our effort to strengthen the existing business continue. We continue to make deep inroads in advanced intermediate and custom synthesis and manufacturing by leveraging our skill set and customer relationship. This, along with increased contribution from Ulichem, will anchor our performance going ahead, as now we are able to onboard new customers in India as well as in the international market on top of the existing customers of Ulichem, who after a brief period of 6 months of low demand are now starting to consume N-butyl lithium on a regular basis. I will conclude by saying that India remains an attractive destination for global majors with promising sectors prospects in the medium to long term. Our sound understanding of market nuances, unique value proposition and unwavering commitment to innovate will set us apart, fostering our growth potential and delivering value to the shareholders. That ends my opening remarks. I would now request our CFO, Mr. Ketan Vyas, to share financial highlights for the period under review.
Thank you, Dr. Hari. Good afternoon, everyone, and welcome to Neogen Chemicals Q3 FY24 earnings call. I shall now take you through the key financial highlights. Please note that these are on consolidated basis and based on year-on-year comparison. We reported revenue at rupees 164.4 crore, depicting a fall of 12% over last year. The quarter witnessed steep decline in raw material costs and resultant realizations, albeit on steady volumes. Chemical revenues moderated on the back of slowdown in pharma and agrochemicals. Organic chemicals saw a revenue decline of 5% at rupees 129 crore, whereas inorganic chemicals noted a decline in revenues by 30% at rupees 35 crore. As stated by Dr. Hari, this was due to significant fall in prices of both bromine and lithium, excluding which the overall revenues for Q3 would have been higher by rupees 35 crore. EBITDA lower was at rupees 20.4 crore, reflecting the impact of higher employee costs and other expenses related to ongoing expansion initiatives around Neogen Ionics. This was in addition to liquidation costs of high cost inventories in Zurichem. That said, the gross margins were largely maintained. In line with the moderated operational performance, PAT came in lower at rupees 1.1 crore. This includes the impact of higher finance cost and depreciation, coupled with one-time tax charge incurred owing to transition to new tax regime. This means our effective tax rate from next year will be lower. The domestic to export mix stood at 78% to 22%. On a standalone year-on-year basis, our Q3 revenue came in at rupees 167.4 crores versus 186.3 crores. EBITDA was at rupees 25.8 crore versus 30.1 crore, and PAT was at rupees 5.8 crore versus 14.7 crore. That concludes my initial remarks. I will now request the moderator to open the forum for Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets only while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to join the question queue. The first question is from the line of Manish Gupta from Solidarity. Please go ahead.
Thank you for the opportunity. So just wanted to check a few numbers with you. Our gross block at the end of FY23 was roughly 400 crores, and the capex that we are doing in FY24, FY25, and FY26 is about 1,500 crores. So barring any new projects we announce, roughly by the end of FY26, will we have a gross block of approximately 1,900 crores? Is that approximately right?
Yes.
Okay. Now, sir, on our existing gross block of 400 crores, you do help us by giving revenue numbers. But the challenge is that because these revenue numbers are so strongly linked to lithium prices and bromine prices, it becomes a bit complex for us to interpret. Would it be useful if you can guide a range that on what is a peak practical capacity utilization, 400 crore of gross block will roughly translate into how much EBITDA at what is a practical peak capacity utilization?
Sure. Thank you. So, see, we always try to give you a range that with lithium prices variation, what is the fluctuation that you see? What is the range in the revenue which can happen, and similarly EBITDA ranges also. But let's say if we take a case, so on a 400 crore, as we had guided earlier, we can have a revenue potential of around 950 to 1,050 crore. And let's say with whatever is our understanding now of a BuLi business, we feel with the same capex or with slightly incremental capex, we can get more revenues out of BuLi. So we can say around 1,000 crores of revenue we can earn. And till we reach the full utilization level, our target would be to achieve at least a 18% plus minus 1.5% kind of a EBITDA range. So let's say around 180 crores, and let's say if you consider the plus or minus range, that's somewhere between 170 to 200 crore EBITDA on a full utilization level in the base business.
Oh, okay. Excellent, sir. So now, if, we say that, let's just work with a round number of about 180 crores. I do understand the range you're talking about.
Yes.
Would it be fair to assume that when we reach peak utilization on the 1900 gross block, our pro rata EBITDA for the company would be 1,900 divided by 400 multiplied by 180, roughly in that range. Could that be broadly similar? Or would because bulk of the incremental CapEx is actually happening in battery chemicals, you think the EBITDA there would, on a pro rata basis, might be lower or slightly higher than the base case?
Yes. So, as I've shared earlier, in the battery business, basically we are looking more from a ROC concept. So we are basically targeting, because that business is going to be driven more with the lithium price, and even other battery materials also will fluctuate, depending on supply demand. I mean, what we have seen is the prices of solvents and lithium, what they were year ago or year and a half ago, versus today sees a lot of fluctuation. So we look more from a ROE, ROC point of view. But let's say if we were looking, again, the EBITDA there was more like 16 to 18% depending on lithium price fluctuation. So broadly speaking, yes. I mean, even if you take the revenue potential which we have given you of let's say 2,500 to 2,950. So on the 2,500, you can assume like about 18%, again plus minus 1.5% kind of an EBITDA. That will basically translate into total EBITDA of about 450 plus, like around 600 to 650 crore. I've just done mental math here. I hope, but that's what. But basically, you can take 1,000 crore at 18%, and another 2,500 crore at 18%. So beyond that, like it will be a pass through. And of course, as we reach full utilization levels in FY26, our target would be then to do a better product selection in our base business and then try to improve our EBITDA margins in the base business.
Yeah, right. Yeah. My third question, sir, is that while the electrolyte is a new business for us, basis discussion with your technology partner, what is the typical life of these electrolyte plants?
So the electrolyte plant which was established in Japan, I think 2 or 3 decades ago, that is still running. The plant which was set up in the US also for 8-9 years ago is still running. They keep making improvements, as customers' recipes become more complicated or modification, but generally the plant will run for a long period of time.
And sir, how do you propose to depreciate these?
I'm sorry, I don't have a very accurate answer on that. I mean, it would be similar lines of what we have, but as of today, I don't have a accurate number. I don't know if Ketan, in our models, if you have taken depreciation, if there is a percentage depreciation you are taking, if you can add, but I don't right now have an exact number or a decision on that currently.
No, we don't do on a percentage basis. We do on the life of the assets, which we await to get confirmation from the technical team.
So currently, are you using a particular number which you have? So it's between 10 years, 15 years, 20 years?
We do about 15 years old. Yeah.
Okay. Fine. And the last question, if I may, sir.
Yeah.
Right now, we haven't announced any capex for the cathode, the LFP cathode.
Yes.
But I wanted to ask that, for a minute, if we assume that Neogen will not be participating in this opportunity, I wanted to understand that players who are getting into the LFP cathode, how will they source the lithium? Will they themselves start with lithium carbonate and refine it, or will they be looking to source lithium salts needed for the LFP cathode from a player like yourself?
So, as we have shared in the past also, that Neogen has not announced any capacity in lithium cathode, but we have capabilities around lithium cathode, both our own developed technology as well as in partnership with international customers. So, let's say maybe not as reputed as MUIS, because, when it comes to cathode and LFP and some other cathode chemistry, this is Very few companies have worked on this outside of China. But we do have this technology. The main reason why we have not done it, because our customers are making several choices. Will they do NMC or will they do LFP? If they do LFP, would they want to import or would they want to make it in-house? And then some of them, because cathode is a very large contributor, they also consider whether they want to make it, when they want to make it in India, whether they would want to make it in-house or buy from a company like Neogen, right? So, because there is not enough demand clarity like we have in electrolyte and electrolyte salt, so we have not moved up with the capex or any plans around that. But we do have a visibility, and our only condition is for cathode we will move ahead only when we have a very firm, like a binding contract or like some kind of a joint development or a joint plant. Some such situation is only when we will basically venture into a cathode area. The way we have currently moved in electrolyte and electrolyte salt, we would not move into the cathode area just because there are multiple options. Whereas for electrolyte, there's a strong clarity that it has to be local. People want to buy from us, and most of the companies are not going to make it ourselves. So this was just clarifying on your cathode comment about Neogen. But on the second side,
sorry to interrupt, sir. We had lost what you said in the last.
I think the management may have dropped off. Operator?
Yes, sir. Right now it's just dropped off. Please stay connected. I'll connect the management line back.
Thank you.
Ladies and gentlemen, we have the management line connected back. Sir, you can please continue with the question and answer session.
Yeah, I'm sorry I dropped off, the call got dropped. So basically, Manishji, to answer your question, I don't know how much but Neogen has made work in battery materials, in the cathode material, but we will basically proceed in cathode material only when we have a strong business clarity and a very committed customer clarity. Because in electrolyte we have that clarity now. We also have that strong need of localization, so that's why we have proceeded further on the electrolyte. And just to answer specifically your question about where they will source the lithium from, so the lithium mining majors generally make lithium carbonate and lithium hydroxide battery grade. So depending on the technology which you are using, in such a case you directly buy carbonate and hydroxide directly from them. At least in the lithium, to the best of our understanding, most of the companies would do that.
Okay. Thank you, sir. I have another few questions, but I'll come back in the queue.
Thank you, Manish.
Thank you. The next question is from the line of Abhijit Akella from Kotak Securities. Please go ahead.
Yeah, good evening, and thanks for taking my questions. Just on the inventory write down first, would it be possible to share a number regarding, how much has actually been written down?
So I think in BuliChem, not a write down, but basically what happened in BuliChem is that we acquired the company in June, and in June there was a very strong demand both from pharma and agro sector. So we imported, the raw material, which is lithium metal and other materials required for making N-butyl lithium. So this material came through by, let's say, August or September, but that is when the specific customers with whom we were working, their demand had gone down significantly, or they had already entered into some contract. So then we were and last quarter the lithium prices, instead of being above stable lithium price, they actually went below stable lithium price. So basically we had to then sell this material at lower cost, which is today's market cost. So because of this timing mismatch, by the time we ordered, the material came and we were able to sell. Because of just the startup related conditions, we were building that inventory. So there was a charge of around 4.5 to 5 crore is our estimate that we lost just because of the price fluctuation on lithium. So that was on the Buli side. And also, as I explained, lithium had gone to stable price. So we were able to manage the journey of lithium from, let's say, $15 to all the way up to $80, and then back at $20-25, which is supposed to be the stable lithium carbonate prices, but today those prices have become even half of that. So on Neogen side also, we had around 2.5 crore related losses, which were because of the price dropping very fast, and we had an option either to wait more or for the prices to recover. But since we didn't see the price recovery happening very seriously, we basically decided to go ahead and sell at what is today's market price. So there was a 2.5 crore kind of a hit on Neogen and around 4.5 to 5 crore hit on the Bewley because of this lithium price fluctuation. So of course, with that, majority of the high price inventory, it's kind of already factored in. There will be some bit of impact on this on Q4, but Q1 onwards, so next financial year onwards, we should be back at normal, and you'll not see too much of further erosion or impact because of lithium price fluctuation. Now in Bewley also, we have a regular set of customers who are getting established. So it's not that we are building up inventory to support. It will be more pass through. So whatever material comes, we think we will have better pass through, and we'll be able to better take care of this in the coming financial year.
Understood. No, that's really helpful. The other thing was on the CSM business. Would it be possible to share some update on how the business has been progressing? If it's possible to share a split between the three components, of the base business, that would be helpful. And then specifically on CSM, how we are progressing in terms of relationships and molecule development and that sort of thing.
So I think, unfortunately for us, the CSM business has done well. It's now already contributing almost 14 to 15% of our revenue. So our goal was to move from 10% to 20%. However, in the advanced intermediate segment, we see a little bit more strong competition from China in the pharma side. So together they are still at about 30%. What we had targeted to reach up to 40%, the advanced intermediate and CSM. This is the exact contribution. Now in terms of the relationship, so the positive news has been that more and more agrochemical companies have already now approved Neogen. We did the first trial campaigns for them, and we have done more than now 9 or 10 different molecules for different agrochemical companies. The demand for these molecules can be as low as 10-15 crores just to start the relationship, to as high as 50 crores per annum kind of a revenue potential. So that's the good news. The difficult news is that in the next year, most of them don't have a very large demand. So while the number of relationships have increased, number of molecules we have increased, but still we don't have a very good clarity, at least in the first half for the next financial year. So we are again hoping that beyond Q2, these existing relationships that we have built or the approvals that we have done will start contributing, as the customers will start planning their 2025 calendar year demand, let's say in the second half, and that is when, if the agro recovers, then we have a good way to basically increase our revenue contribution from CSM business. Further, as we had mentioned, we also have now several projects into flavors and fragrance segment. So these are also now moving along, as well as some non-agro, non-pharma, non-flavor, like specialty application kind of molecules. So these also are now contributing. So to some extent, whatever agro we were not able to get because of weaker demand, these flavor and fragrance and other industries are supported. So when agro comes back, it will help us to make our CSM and advanced intermediate business stronger. Finally, our goal was that once the Dahej site is there, we start talking to the large 5 agrochemical companies in Europe and US. So most of these discussions have initiated. They have also started their evaluation work. Of course, there's a bit slowdown, because of lack of demand or lower demand from their side. But still, they have recognized the capabilities that we have in bromination chemistry, Grignard chemistry. Now that we have a proven 7-8 different molecules of multi-stage synthesis, as well as the synergies which come with this N-butyl lithium. In fact, those projects where there is N-butyl lithium use, we have seen maximum interest. So I think all of these, once the agro demand will pick up, will really benefit us.
Understood. And sorry, just one more point to clarify with regarding our strategy in this CSM business. So we intend to focus only on commercial scale molecules, or like some other peers in this industry, we intend to get into the relationship right at the stage of, say, molecule development early on during R&D or early commercialization, and ramp up the relationship from there. How would our thought process be?
So, so far all the work which we have done is more on the commercial manufacturing side, and so basically developing commercial business and focusing our R&D efforts on that. However, we are in the process of expanding our R&D lab also in Karkhadi. So this capacity will basically come online like sometime in the next financial year. So once we have this additional capex, part of this, especially in pharma, what we have seen is that sometimes it helps if you start this relationship really early on. So we will also maybe offer a little bit of our R&D capabilities of that. But in terms of revenue significance, it will be more it's not basically for revenue, it's just to start the relationship early so that we can, have a better pipeline. So that will be that's the only difference. But otherwise, our focus still remains on more commercial, and in terms of revenue coming in, the revenue will largely be from the commercial manufacturing activity.
Got it. And one last thing from me. On the battery chemicals business, there has been some sort of growing amount of news reports regarding somewhat of a slowdown in the adoption of electric vehicles, etc. So in that context, how do you see the industry progressing? I mean, is it broadly rolling along as per your original expectations, or are things moving a little bit slower than you expected? And with regard to your project's commissioning timeline, plus maybe what others have announced, how is the situation looking in terms of timelines, in terms of demand, etc.?
Sure. So, so far whatever we have seen, I mean, we still feel that the India demand kind of continues to grow. See, the fact in India is that there's already a demand which is not being met because today we are not manufacturing the cells, right? I mean, there's already a strong demand which would have existed today for battery materials if there was a cell manufacturing capacity. So most of the cell manufacturing capacity in India, as we had stated earlier, remains on track. So in the 2024, we will start see some cell manufacturing happen, like 1 or 2 gigawatt hour level projects will just make their start, and then they will basically ramp up in early 2025, and few more will come, let's say, in the second half of 25. So if you go to 2026, my estimate is you will at least have 4 or 5 projects. And so we'll already have 4 or 5 projects, 4 to 5 plants which are basically working at a gigawatt hour levels. And by 26, I also see the ones who will start in 24 scaling up their operation. So I think from a timing perspective, our electrolyte plant starting now will take care of the initial gigawatt hour plants which are coming up in India, as well as some international customers, as well as some non-EV, but let's say electronic battery customer demand as well. So we'll start with that in 2024, which is basically FY25, and then their initial ramp up also will take care from Dahej. And our target remains that in the second half of 25, so let's say somewhere around, let's say December 2025, 1 quarter before or after, is when we expect the 30 KTA plant to come. So I think it will be in a perfect time that in 2026, when majority of these customers are ramping up and more new plants are coming online, we will be ready from the beginning to take care of them for their electrolyte needs. Similarly, if you would have observed in our opening remarks, the international battery material demand non-China, because of IRA and because of heavy dependence on China, so alternate source to China remains strong. So there's a very strong interest in a non-Chinese electrolyte salt and additive demand, and this is why our original plan was to increase 400 to 1,000 and then from 1,000 directly go to the 3,000. But we had to increase the capacity to 2,500 metric ton to take care of the demand before our new plant will come up. So in fact, the way we are seeing that demand come in, it's actually getting preponed, the electrolyte salt and additive demand, as compared to what we had originally estimated. Whereas I think electrolyte demand remains on track. And I think overall, if we talk of just EV and energy storage, we feel there's a bit of slowdown mostly in China. And of course, there's a little bit of challenge which people have seen in the US. But still, EV numbers continue to grow in all the regions. And I think the commitment of majority of the automakers also still remains. And the non-EV, which is basically energy storage application, is still picking up. Still the models are getting set around that. So that is also still a demand as the world moves more and more to renewable. They will basically need more energy storage. So I think more or less we feel our electrolyte demand, the way we see, remains on track. The electrolyte salt and additive, we have actually preponed and added some more additional capacity, which has been also one of the reasons why our capex numbers have, the estimated capex numbers are higher. So that's based upon the final design that we received from Mitsubishi and this additional salt capacity which we needed to have, because we see the electrolyte salt demand kind of getting a little bit preponed in the international market.
Understood. Thank you so much, Dr. Harun. I wish you all the best.
Thank you so much.
Thank you. A reminder to all the participants that you may press star and 1 to join the question queue. The next question is from the line of Jason Soans from IDBI Capital. Please go ahead.
Yes, sir. Thanks for taking my question. So first of all, sir, just actually wanted to, confirm, from a previous participant, you mentioned that on a gross block of, just wanted to confirm this, on a gross block of 400 crores, just considering stable lithium prices and bromine prices, we're able to do revenue of 1,000 crores with an EBITDA margin of 18%. And then same thing, you mentioned that for battery chemicals business, with an EBITDA of 18%, 3,000 crore revenue potential. Is that right? That's what you mentioned?
So 18% on 2,500.
Yeah.
The lower side.
2,500, 18% on 2,500 crores. And on the base business side, 1,000 crores with an EBITDA of 18%, right?
Correct. And plus or minus 1% is what we take in that. Both, yeah.
Yes. Okay.
Depending on the euro. Yeah.
Yes. Sure. And sir, just wanted to know, in terms of, we have spoken about this before, that in terms of, sir, realizations, probably we're looking at a number of, for electrolytes, 7, probably something in the range of $5 to $10 per kg. Just wanted to know, in terms of electrolytes as well as lithium salts, what are you taking an average realization considering a stable or an average lithium price? Just wanted to know what are the realizations you are taking in your calculations for this, for both these electrolytes as well as lithium salts.
Yeah. So, the electrolyte realization is somewhere around $10 and will depend basically on a recipe to recipe kind of a situation. Okay. Because each customer has a unique recipe in which, so it's very difficult to give one single price. And also, like I said, there's one price in China, there is one price in Japan, there is one price in US, and all of these are varying quite a bit. So what will be India's price depends on the volume. It will change as the volumes will increase. But again, as we said, electrolyte business is mainly going to be like a ROC driven kind of a business, and at least we see a ROC of 20% plus. So that's basically the basis of our assumption. So actually EBITDA number is like a derived number, but ROC is what we are targeting, because as you keep increasing higher capacities, you can afford a lower price based on the ROC that you are doing.
Okay, so $10 per kg is what you're working with currently, of course, and lithium salts, sir, in dollars per kg?
So again, there are multiple salts, and the range would be let's say around like $27, $28 to $35 in that range.
Okay. Sure. And so just in terms of in terms of electrolyte lithium salts, how are you looking at the traction on the ground with the negotiation customers, being Ola and TVS, Panasonic, etc.? How are the negotiations with the customers? Just could you speak about some color on the ground? How is the traction going on?
Yeah. So, we are having very good conversations with all our customers. Of course, the customers, so we have been giving few kg samples to these customers for almost last now 15 months. Now some of these have started like a larger trial. So they are also now buying, let's say 100 kg, 200 kg kind of electrolyte volumes. And most of them are expected, at least 2 or 3 of them are expected and actually are after us to ensure that our facility will be ready, let's say by end of the current financial year, because they are expecting trials larger trials of their commercial plant start, let's say in the first half of FY25. So we are on track basically to deliver that. So our facility will be ready so that we can give them the initial trials. So far, whatever they have visited Neogen, whatever quality systems of Neogen they have seen, or the quality of electrolyte they have seen, they are very happy with that. Also now with MUIS, we give them the option that if they want to try MUIS recipes, so we can also work with MUIS to suggest to them recipes which can improve the performance of their cells. So this is also taken very positively, and most of these customers remain engaged. In fact, what we are seeing that even more new OEMs in India who are either planning in future two-wheeler and four-wheeler, they are also engaging basically when they want to consider the option of making the cells in India. So this is in the Indian market. And internationally, basically, when we are talking of the electrolyte salts, so again, we are working with several customers where, they are visiting our sites, they are taking our samples. Some of them have already approved our, samples from either R&D or the early production sample runs from the trial production runs. So we are also seeing a very positive feedback both on the salt in the international market as well as the Indian electrolyte customers, future potential Indian electrolyte customers.
Sure, sir. And sir, just if you could just explain, sir, electrolytes of course have to be sourced locally, and I believe what is the impediment or what is the hurdle to so that it cannot be exported? And I believe lithium salts that can be exported. Is my understanding correct, or?
Yes.
Could you just So what is the impediment towards an electrolyte solution being exported or something like that?
Yeah, so
why does it have to be made locally?
See, if you look at Mitsubishi, when they started in Japan, this technology started in Japan to set up a plant in Japan. Then similarly, when their customers moved to, let's say, US, Europe or China, so they also set up a plant in US, Europe and China, instead of just setting up more capacity in Japan and ship, right? So the main reason in this is that, electrolyte require very low moisture content, very low acidity, very low impurities, and some of them have additives which require also temperature below 10 degrees. So if you think of tanks which are required for transporting this across the world, right? The cost of such a tank and the cost of transportation and sending these tanks to the customer, bringing them back, and especially if you have multiple customers with multiple chemistries, making sure that you deliver them, on time, whatever is needed, the particular recipe. So this is more complicated, and that's why, in terms of the performance and the quality of the electrolyte, it is always preferred that the electrolyte is made locally. Okay. Now, when you think of electrolyte salts, this salts, first of all, the volume of the salt that you are sending is usually between, let's say, if it's a salt, it's between 10 to 15%, and if it's an additive, it's between 2 to 5%. So the quantum of salt that you need to ship as compared to the quantum of electrolyte reduces, right? The second thing in this is that this doesn't require low temperature, the shelf life is longer. It still requires moisture-free conditions, so it requires a specialized packaging, but the volume of it is lower. And the fact today also remains that 90-95% of the salt is in China. So people are anyway used to buying from China and then making the electrolytes locally. So therefore, when we are going and offering, let's say, a salt, so then what the question which is simply remaining, instead of importing from China, I have to import from India, right? So that's why we are not making a very big change from what is already being done. So that's the reason why salts are more easier to export in the international market, whereas electrolytes are usually made locally. So therefore, we are not targeting very large export market in electrolytes, as well as the fact that we are also not seeing most of the Indian customers basically relying on imports totally to basically get the electrolytes into India on a large scale on a sustainable basis.
Yeah, sure, sir. Sure. So, okay. So, sir, fine. Now, in terms of, sir, of course, we have seen, specialty chemical companies, we've seen a weak underlying demand, which is driven by driving down raw material prices and hence realizations as well, especially with Chinese competition, especially with generics, etc., being very intense. And they are driving down intermediate prices also. So just, sir, in your sense, do you think we have bottomed out? Or, just some color on how have we bottomed out? Probably we can see a gradual recovery from here on the world markets. What's your sense on the entire pricing? Of course, with the falling prices, our EBITDA also, absolute EBITDA definitely has gone down. That's been the story of this. So just wanted to understand from in your sense, how is it? Do you see the prices realizations having been bottomed out? And a gradual recovery from here on, or is there more pain still left?
So what we have seen is that in pharma, we are basically saying that, more or less, again, in pharma, there are some customers who are basically doing okay. And there are some customers who have already recovered, and there are still some customers who are, still recovering. So there are some categories antiretrovirals or some specific large molecule even related to heart-related ailments. So they are still seeing that, there's still inventory corrections happening and the demand is still coming up. Whereas there are some segments, more specialty, more niche pharma, have already recovered on the pharma side. On the agro side is where we've seen more challenge, where people are still not getting visibility. So of course, our supply chain is in the international market, especially in Japan, and in India, basically people who are working with innovators. So most of these are basically guiding us that only in the second half of the calendar year, when they will start looking at 2025 demand, that is when basically agro will improve upon. Also, so in terms of raw material prices, we really feel that most of the people had predicted a stable lithium price, which is slightly higher than the previous 30-year-old average. Let's say the 30-year-old average is at around $12 to $15 of lithium carbonate, and what most of the people were predicting, $20 to $25 will be a long-term stable price of lithium. But unfortunately, today the lithium prices have gone down towards historically low or historical low average of $10 to $12. So we don't see further decrease, because as that happens, more and more new age mining companies or the newer mining companies, who especially those based out of Australia, will not be able to sustain it for a long period of time, reducing the supply. So anyway, this is what is our belief, that it should not reduce further down. If at all, maybe 10-15%, but not a very large decrease from today. And because the prices have gone down so much, by 2025-26, when there is again revival and more battery production will come in non-China markets, that is when you might see another lithium price jump. So this is anyway my estimate, but let's see how the markets proceed. And I think our EBITDA, it's bearing this particular lithium thing, and the fact that we have not yet reached full utilization the way we have targeted. We feel more or less our EBITDA margins, we have still done a decent job to protect it. It's just that this $25 to $12 was something which took us by surprise, and our customers held back, and especially the Julie situation, because we were just starting. It came at a little bit wrong time when we were not fully ready. But going forward, we'll be able to manage it better.
Sure, sir. Sure. And sir, just wanted to...
sorry to interrupt.
Yeah.
Jason, sir, may we request you return to the question queue as
Sure,
there are
sure,
several
sure.
participants waiting.
Sure.
Thank you.
Sure.
The next question is from the line of Yash Shah from Investec. Please go ahead.
Hi, sir. Thank you for the opportunity. My first question is more of a clarification question, sir. Last quarter, sir, we had revised our expansion for the salt, electrolyte salt, from 2,000 tons to 4,000 tons. I heard you saying basically 2,500, mentioning 2,500 something. I'm really not sure about it. Can you please reiterate the same?
Sure. So the 4,000 was broken down into 1,000 metric ton in our Dahej facility and 3,000 metric ton in the Greenfield facility. So now, because we are seeing more stronger demand of the salt, that 1,000 is being increased to 2,500 metric ton, and we are seeing 3,000 metric ton still in new Greenfield remains constant. So total is becoming 5,500 metric ton. So what we had increased from 2,000 to 4,000 now stands increased to 5,500 metric ton, and the increase is basically coming in our Dahej facility, because the customers are not able to wait till our new facility comes online. So we are using the existing land available in Dahej to increase to this capacity.
Understood, sir. So basically, and this the rest of the 600 tons, it was expected to come by the end of next quarter. So now, since we've increased it to 2,500, when is that expected to come, sir? Since we've increased the capacity on the brownfield side.
Yeah, so our 400 ton, like I said, all the trials and everything has started. That's basically commissioning this. Let's say we are having several phases. So like 1,000, then maybe we'll have a 1,500, and then ultimately 2,500. So our target is at least 1,000 and the 1,500 to come online, let's say in Q2 or Q3, and 2,500, let's say by end of Q4. So by end of next financial year, we would be at 2,500 totally, and it will be in phases. So as you said, 1,000 will come first, then there is another particular plant getting added which will increase it to 1,500 and then 2,500. All of that will be happening in next financial year, and then that will take care of FY26 requirement of our customers, and then another 3,000 metric ton will get added in FY26. That will basically take care partly of our own electrolyte requirement and partly take care of the additional requirements of our customers.
Understood, sir. That was really helpful. So my next question was on the base business. Now, as we've mentioned before that, we had a 36 crore impact in the current quarter. So now if you just look at the numbers which were there in the last year, same quarter, we would ideally touch 200 crores, and that will be ideally the same at the same amount of volume. So just really wanted to understand, since agro makes about 60 to 65% of our base business, is it like which end user industry did you see this demand from, and also in which geography, sir? If you can just harp a little bit more on that.
Sure. So just to clarify, that 200 crore what you have calculated is when the lithium prices were at its highest, right? So again, that was the peak volume, and of course on a full utilization we will cross that. But today we are not there, so the plants are not fully utilized. The second clarification I wanted to make, for us pharma was always higher, so it's 50 to 60%, and agro was around 20-25%. So that 20 to 30% in that range, depending on. So that 20 to 30 is a bit lower, which has been right now made up by pharma and like some business which I told you, flavor and fragrance, and some non-pharma, non-agro, so basically other industries. So that has made it up.
Understood, sir. Understood. And any particular geography, sir? Is it Europe or US, Japan? If you can.
No, so currently, especially our agro business, as you know, was mostly international. So, and even in India, it was linked to the international. So that is where you have seen our exports have gone down significantly, mainly driven by that, as well as the fall in lithium prices. So it's mostly we have done more pharma customers. So we've done molecules which we were normally not doing, but we've done those molecules in this quarter to make up for the shortage in the demand. So mostly it's pharma, generic India.
Got it. Got it. And sir, one last question. I just wanted to understand what is our current gross debt, and with this expansion coming in, what do we target as our gross debt to EBITDA ratio or net debt to EBITDA?
So our gross long-term debt today will be somewhere around 150 crores. And like say working capital will range between around 200 to 250 crores, in that range, depending on which period of time you are basically looking at. I'm sorry, I don't have the number for long term, and maybe in the next call we'll prepare and we'll give you an update on that. Or you can send us an email, and if it's not a non-public information, we'll try to share it with you.
Perfect, sir. Perfect. Thank you very much for answering all my questions. All the best.
Thank you.
Thank you. The next question is from the line of Anirudh Shetty from Solidarity Advisors Private Limited. Please go ahead.
Hi. Thank you for the opportunity. So my first question was on, when we look at our battery chemical business, the assumption of margin behind that ratio of 20% upward is actually 18%. Just want to understand, unlike our bromine business where we have a long-term history, the business model is more established. This is more of a nascent business. The economics are evolving. So wanted to understand the basis behind, our assumption of 18%. And also, there is two segments, electrolyte and salt. So if you could just give some color on what is the implied margin for electrolyte and salt respectively.
So, the basis for our assumption is basically what we are looking is that, okay, if we are doing investment, we are taking the risk if we are the first mover, and to able to justify the risk and the investment, this is the bare minimum that we need. Now, when we put that bare minimum number and arrive, let's say, at what is my selling price, right? Because you would put all your costs, your depreciation interest, then you'll put this number and arrive at a cost. And what we have seen is that when we put that cost, let's say when I'm talking of salt, we are expensive as compared to China, but we are cheaper as compared to Japan and Korea, which are the next two available options, right? So then we are confident that, look, this is something which if somebody says I want a non-China price, or in fact, if we are looking at more stable, because right now the China prices are very depressed because of overcapacity. But if I were to, put the old lithium prices, and if I were to look at stable salt prices in China, we are more or less tracking that. So that's the reason why we feel confident enough that this is something which, we will be able to use it. We'll be able to get. Similar situation in terms of electrolyte. So when we put this number in our models, look at the electrolyte prices, what we feel that when I am looking at the price, we are somewhere lower than the prices which are, let's say, prevailing in Japan or Korea, and let's say within the range of the lowest and the highest Chinese prices. So we feel like, if the remaining markets also are able to sustain that, and this is what we have done. So therefore, this is a business. Again, there's no buyer, there is no seller of this in India today, and this is a fragmented, more geographical, concentrated market the way we have seen. So therefore, right now, this is the basis of our assumption.
Got it. And right now, there's no local manufacturing. A lot of it is being imported. Would it be fair to assume that a lot of the imports are coming from China? And at certain scale, would it be fair to assume that as a local supplier, and there would be some PLI benefits as well, would we be cost competitive versus China at a cell level, or will there be requirements or some anti-dumping duties to kind of bridge the gap?
You are saying at the cell level?
Yes.
I think this is a question you have to ask my customers, cell manufacturing. But most of them are confident enough that they should be able to, because what we have seen worldwide, and I think if you see some international reports also, while the cell manufacturing cost has dropped, like, dollars per kilowatt hour has been dropping. But what people are commenting that majority of the scale benefits, are already achieved. Like, for example, when somebody was making only 10 megawatt hour or 100 megawatt hour, from there you went to like 1 gigawatt hour. So, the savings that you do when you move from 10 100 to 1 giga is substantial. Then from 1 people started going to 5 or 10 gigawatt hour, and then from 5 and 10, now, today people talk of plants which are 20 30 giga. So as you start going to these scales, so as long as you started designing your plant at like 20 giga, 10 giga, 20 giga and multiples of those, what I have gotten the feedback is beyond that the scale benefit is not that much. Okay. So basically then you are basically driven simply by what is the material cost, what is the efficiency with which you are operating, which will basically make like 10%, 15% kind of a difference. So I personally believe majority of the scale benefits that we needed to get, we have gotten. The Indian companies are also talking of, at least their initial plans are all 10 giga, 20 giga, and some of them are even considering like a ultimate 50 or 100 giga kind of volumes. So I'm confident that they will be competitive, in terms of competing against China in a fair competition. Now, I personally feel the PLI benefit will help them get to that scale, and after that, if the fight remains fair, then I think they'll be able to manage well. If it's unfair, then you need something like an anti-dumping duty protection if somebody decides to just dump like crazy, and we've seen China do that in China, in let's say even in pharma markets and in other markets. So that's where the government, if it needs help, I feel they are quite committed to protect the Indian companies in that level.
Got it. And just one final question.
Sorry to interrupt, Mr. Shetty. May we request you return to the question queue for the follow-up questions? Thank you.
Yes, will do. Thanks.
The next question is from the line of Archit Joshi from B&K Securities. Please go ahead.
Hi, good evening, Hari sir. Thanks a lot for the opportunity. I just have one question. So just building up on the previous discussion that we were having with respect to the amount of gigawatt hour capacity that is rather going to be built up over a period of time. But I'm slightly looking at it from a myopic perspective from, let's say, for CY24 or CY25. I think the earlier anticipation was that we'll have close to half a gigawatt, maybe 1 gigawatt hour sort of a capacity in India in this year. And then it will start, sort of doubling up exponentially over a period of time. In the current scheme of things, sir, in your discussion with your customers on the same account, especially in domestic battery manufacturing, where we are mostly going to sell electrolytes. Sir, what is the progress there, sir? And how exactly do the sale get generated? Is it that it goes into a testing phase, wherein our pilot plant will be occupying more of capacity towards that particular demand, and then it takes maybe a year's time to ramp it up from 0 to 1 gigawatt hour. So that time frame is essentially something that I'm curious to understand. If you can explain both these things in one. Thank you.
Sure. So I think, the way this will work is that, our principle has been we have to be ready when the customer is ready. Okay, because if they want electrolyte and if I don't have a plant to make an electrolyte, then basically we are forcing them, even if they don't want to basically import, correct? So if you look at what Neogen has done is, so there were several customers in India who for last 15, 18 months had developed a capability to make the cells in the lab, so few 100 cells, 200 cells. So we were also ready with our facility, and even up to 10,000 cells, etc., kind of a demand when they wanted, we were able to basically give them the few 100 liters of electrolyte. We were the only Indian company who was able to do that for last, let's say, 18 months. And most of these customers have either bought the material to make their initial cells or send the material for evaluation to their international partners who can basically evaluate the cells. Now, next what will happen is, as these people set up their giga plant, they will also need electrolyte to support a giga. And like, if, as I said, 1 gigawatt hour, depending on NMC or LFP, is somewhere between 500 to 1500 metric ton. So let's say the 2000 metric ton capacity can support up to 4 gigawatt hour of NMC cell production in India, or let's say 1.5 gigawatt hour of LFP, or on an average basically 2 gigawatt hours of cell production can be supported by our existing facility. So if you, and this is a facility which we have from now till let's say September or December 2025. So will India at least make 2 to 3 gigawatt hour of cells, let's say by December 2025? So to me the answer is yes. With whatever is happening today, they will be at a 2 to 3 gigawatt hour, or let's say per month, if you are thinking of around 0.2 giga per month kind of a production, which can be supported by my existing plant. In fact, if they really ramp up well, I might even have to increase this. I mean, till the bigger plant comes up, I may have to increase this 2,000 to 3,000 or 4,000, but with the basic infrastructure in place, that can happen relatively quickly. So we'll be ready for that if it's needed. So I think that will take care, and I personally feel that once they start giga production in 24, 25 they will start stabilizing, and there will be more people who will come online in 25, and 26 is when the guys who will stabilize in 25 will jump, make the 5x jump in 26, and the guys who are stabilizing in let's say 24, 25 who are starting, they will also have some initial requirement in 26. So the 26 is when, we need that Mitsubishi plant to come online. So we will keep watching, how they are progressing. And while the Mitsubishi plant, so they already finished the design, they've already shared the final design numbers, estimation of the what is it that we will need. So we have also completed that, and we are in a very advanced stage talks with some of the lenders who want to give us a very long term. So they also looked at this as a priority long term project finance kind of a mode. So like they are giving us preferential terms also, so that we can manage, our debt service coverage ratios and things like that. So I think if we look 2030 number of 150,000 metric ton kind of electrolyte demand, I personally feel that will happen. By 2025 end, will my 2,000 metric ton run at a full capacity? My guess is yes. So if I'm starting in, let's say March 24, and by let's say 18 months or 21 months, if I'm reaching full utilization levels, I will be very happy with that. And the 30 KTA plant, I still believe, if it starts in end of 2025, basically in FY26. So full utilization of that might happen in FY28 or FY29.
Got it, sir. Just a small one. So this year we are not expecting any battery capacity to come online, right?
No, the salt is coming online. So that, like I said, already trial runs have started. And if everything goes well before March, we will start at least make some trial sales. So that's our internal target, to at least start some battery sales before March 24.
Sir, not ours. I was talking about the gigawatt hour capacity in India for this year. Any visibility on that?
When you say this year, meaning FY24 or FY25?
Let's say FY24, this calendar year.
No, I still have, there is battery capacities which would come online in calendar year 24. At least whatever I have seen so far, they will not be fully optimized, they will not be running at full capacity, but they will start manufacturing cells in the current financial year. I mean in the current calendar year 24.
Got it, sir. Thank you. That's great, sir. Thanks. And all the best.
Thank you. The next question is from the line of Manish Gupta from Solidarity. Please go ahead.
Sir, just wanted to ask, for this entire CapEx program, would you now need to raise any more equity?
We'll answer that question. As of now, we feel what we have raised is sufficient enough. The banks also, the financial institutions also with which we are also working with are also satisfied with the amount of equity which we have raised. So it's not a necessary condition, but whether it's a desirable condition or not, and when, between, let's say, now till 2026. So that's the question we'll take a look. That will depend on how fast and how aggressively the base business will recover, how BuLi will start contributing, and how exactly we are phasing out the electrolyte salt and electrolyte capacity. So we'll keep a watch on that. Again, it's not a necessary condition, but if it's a desirable condition, considering market volatility, we'll basically take a view on that as the year progresses.
Just to follow up on this, sir, that you've mentioned that you are comfortable with a debt to equity of 1.25.
Yes.
But if we were to look at, a lot of our earnings are perhaps going to be more back-ended, more FY28 and FY29, right? What is the debt to EBITDA number that you will be comfortable with, say, going into starting FY27?
FY27. Okay.
Yeah, because that's when the battery chemical business will really start contributing, right? So that's the build-up phase.
Okay.
So if it's a 1,500 crore capex program and you're not going to raise any more equity, the amount of debt in the business relative to the earnings or the EBITDA, seems to might really expand. So what's the number you're comfortable with on debt to EBITDA?
So ideally, we want debt EBITDA to be below 3, but like I said, for a certain period of time, as long as we have comfort in terms of, the repayment schedule. So like the DSCR and those numbers also become more relevant, right? What is the interest you are going to cover, etc. So I think, ideally we want it to be below 3. Okay. We know for a certain period of time, it will be high, so that's a call that we'll have to take at that time.
Thank you, sir.
That's the reason why I told you that, it's not that we are close to taking equity. So we have the necessary equity. If we want a desirable equity, that's something which we'll keep evaluating.
Yeah, very clear, sir. Thank you.
Thank you. Ladies and gentlemen, we would take that as our last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you all the participants for joining the call and your very interesting and insightful questions. I hope we were able to address your queries. If you have any further questions, please feel free to reach out to our investor relation team and we will address them. Thank you once again, and we look forward to connecting with you again in the next quarter.
Thank you. On behalf of Neogen Chemicals, that concludes this conference. Thank you for joining us. You may now disconnect your lines.